Hello and welcome to another webinar that I will be conducting on behalf of IBFX. I conduct these every 2 weeks. I just actually updated the webinars for March, so we'll talk about that as we get to the final screen here. But my name is Brian Kahn. We'll be applying the 5 and the 9 moving average and using it in a crossover method. And I thank you in advance for your attendance and also very important for your participation. I can't stress that enough. That participation is crucial as your questions will lead to other topics, whether it's technical analysis, fundamental analysis, trading psychology, dissecting other pairs. So please ask questions and I'll check in with the panel here throughout the broadcast. You have my email there. Some of you know that you can contact me. Some of you have contacted me in the past with questions. And then you have the website, IBFX's dailyforextradingedge.com site, where I post my market commentary. I posted an article there today and a couple additional charts. And then my website, jupiterpeakfinancial.com, where I host my information and my approach to education when it comes to individual traders and investors. Before we go into things, let's just get the disclaimer out of the way. I'll leave this up for just a few seconds. And the next disclaimer as well, volatile markets, which we talked about in the webinar 2 weeks ago about volatility, and it was obviously a pretty good timed webinar, a precursor to an increase in volatility over the past few weeks. In volatile or fast-moving market conditions, stop and conditional orders become market orders to be filled at the prevailing price, which may be vastly different from the desired price. Stop loss or conditional orders do not always guarantee a fill, and such orders may not be filled as placed. Substantial losses may still occur. The bottom line is there aren't any guarantees out there, and you obviously have to be able to manage your trading risk and account risk correctly, and always managing the amount of contracts you put on and the amount of pips that you're looking for, and obviously be aware that things aren't always go exactly or don't always go exactly as planned. But that can be a good thing because it could happen on the other side as well, obviously. Outline of where we're going, fundamental analysis always, a quick macro and micro catch-up of recent events. Lots happening this week in the economic calendar. Technical analysis, we'll talk a little bit about intermarket relationships and are there any intermarket relationships. And then getting to the moving average crossover. Why did I choose this application of the moving average for this webinar? So why the 5-9 period, and is there anything else that I can use? There's no holy grail out there, so what else am I using in conjunction with my 5 and my 9 crossover? And then we'll apply it, and again, we'll finish up with a review, links to resources, and questions. But again, questions are important throughout the broadcast, so please type them in as you have them. We have a pretty large crowd today, so I expect questions to come in as we move forward throughout the presentation. So the fundamental analysis, I can't stress the importance of this enough. I'm always looking to discuss the current events and analyze those current events and what they mean for traders and investors. Your broker provides a link for you and lots of analysis. We're going to talk about fundamental analysis tonight, so that's where IBFX is helping you out. You obviously know that there's other collaborators on that Daily Forex Trading Edge page, so make sure you take advantage of the other analysis there as well. TV stations, websites, whatever you use in your daily routine, but you've got to have a daily routine. I work a lot with traders that aren't in the Forex markets, and they might be in the equity markets, the option markets, and a lot of them have full-time jobs. They're not day traders by any means, but they still have to make sure that they can take advantage of technology, whether it's their laptop, whether it's their phone, whether it's their pad now, to make sure that they're checking in with the markets and staying on top of the fundamental events, because fundamental events are definitely driving us. So before moving into the next slide, I'm going to switch the screen here really quickly, and we're going to jump over to the internet, and I'm going to bring up the economic calendar here for this week. And boy, oh boy, is it a busy week this week. So we already had Bernanke talk, and Bernanke had mentioned that he's still here for the markets. He believes that asset purchasing is still the way to go. So that was yesterday and today in his twice annual testimony in front of the Senate and then the House. So Federal Reserve Chairman Bernanke testifies So he went yesterday. We also got in the U.S. some really good data out of the new home sales, out of housing market. And then you slide into Wednesday, and not only was Bernanke speaking, but you also had Mario Draghi speaking, and he talked about outright monetary transactions, OMTs. That's what I talked about in my daily market commentary today on that Daily Forex Trading Edge page. So they're still there supporting the markets. That helped the equity markets today stabilize and definitely go higher. We also, again, had good news in the USD with the core durable goods, which strips out the volatile transportation sector. And also, again, we had home sales blowing it out of the expectations today and being above expectations. And again, as I wrote in my commentary today, still be on the lookout for CHIPM tomorrow, Purchasing Managers Index in the Chicago region. We obviously have, as we do every Thursday, we have unemployment claims. That gives us an idea of what the unemployment picture could be like in the U.S. And then also on Friday, we have another manufacturing data set in the form of the national number, Purchasing Manager Index. In the form of ISM, the Institute of Supply Managers. So that's the national look. So on Thursday we get Chicago. On Friday we get the national look. But lots and lots of data still to come out. Again, when I talk about macro and micro events, the micro events right now are what we're looking at here, the economic calendar as far as employment data, inflation data, manufacturing data, retail sales, durable goods. The macro data is Bernanke talking, Draghi talking, the vote in Italy, bonds and their auctions and their yields, as those happen quite frequently. And then also, obviously, governments like sequestration and the budget talks here in the United States. So lots and lots to deal with, and I can't stress enough that the macro events are really important. Again, I talked about a webinar 2 weeks ago about volatility, and the markets have gotten more volatile since the past couple of weeks, and the trading ranges have increased, which is good for traders. But if you're attacking them and saying, oh, things are volatile, the volatility gauge is up, I'm going to be able to trade a lot more because the ranges are bigger. If you're forgetting what's driving it, then you can be in trouble, because if you're not waiting for very, very, very specific trading locations with trading plans, you can get caught in the middle, and the middle can be very far from where the markets stop going. So we've had massive, massive, massive moves as of late in the equity markets, and it's starting to transfer over to the Forex markets with larger trading ranges. So this is your economic calendar. You've got to be ahead of the game and know what's going on. You don't want to be dancing trying to enter a trade and not know when this stuff is coming out. So please, I can't stress it enough, this is part of your daily routine, all right? Moving forward, technical analysis. This is just a slide to set up where we're going as we enter the charts. 3 key words: trends, support, and resistance. Trends. Which way is the trend going? I don't know who you are and what time frame you're trading on. If you're trading for the next 5 or 10 minutes, what's the trend for that time frame? If you're trading for the next 5 or 10 days, what's the major trend then? Support, where generally there's more buyers than sellers. Resistance, generally where there's more sellers than buyers. And then if you can find intermarket relationships where you can say, hey, this is a commodity currency and it's tied to this commodity, and I see this commodity doing this, is the relationship. Or, hey, this Federal Reserve or this central bank just said this, I believe that's going to be weak or strong for this pair over here, and can I relate it? So what can I look at and use? That's that slide that I went back, that I can slide back to right here on the outline. What else can I use in conjunction with the 5 to 9 moving average crossover that we're going to talk about? Is it fundamental analysis? Is it another technical indicator such as a trend line, a Fibonacci? Can I line up, as I say, more than one moon? I'm not just focusing on one thing. I could be and say this is a really good opportunity just using this indicator, but I still want to be aware of the bigger macro picture out there, the fundamentals, and I want to be aware of maybe some other technicals in the background. Intermarket relationships, there's no doubt, because I use them. The main one, which way equity markets go and which way the U.S. dollar goes in reaction. They've broken down as of late, and so equity markets are all over the place. For the most part, as of late, the U.S. dollar has been stronger against most currencies out there. That's been as a function of the Federal Reserve minutes that started all of this volatility in equity markets, where there saw some dissent, where they saw some Federal Reserve members saying, you know what, I don't know if we need to keep doing this asset purchasing and keeping this accommodative stance and keeping interest rates low. But then again, boom, a few days later, you have their chairman, Ben Bernanke, today or yesterday coming in and saying, you know what, We need to, guys. I'm the chairman. We need to. And again, that's where the macro fundamentals come into, because we had a massive, massive, massive day in equity markets around the world today. Not as busy as far as ranges in Forex, but the point is things are getting busier, and there's so many people talking so frequently that are driving these markets that you still got to be aware of the fundamentals. So are you able to find any intermarket relationships that are giving you a trading edge? One that I use very often has broken down as of late. So that doesn't mean I can't search for others. That doesn't mean I can realize that it's broken down and not use it for now. It may come back down the road, but there's always other things that we're trying to adapt and be flexible and move around to in keeping our eyes open. And quite honestly, that's why I like educating, and that's why I like teaching, because people ask me questions that I might not have thought of on my own, or they might say, look at this pair or look at this relationship. I can't keep my eyes on everything out there. So it's a win-win for me to be working with individuals like you, because it just keeps me on a wider parameter as far as what I'm viewing when it comes to all of the relationships between the financial markets. All right. So moving forward into the main subject tonight, the 5 and the 9 moving average crossover. Again, why this application? Well, when I did this webinar and created this for IBFX a few weeks ago, almost more like a month ago, ranges were really, really small and volatility was a lot lower. And I thought that the 5 and the 9 gives me a quick entry, a quick exit, and would help me in tight markets. So overall, volatility still is somewhat low. It's moved a little bit higher, but let's face it, the equity markets around the world are right back near their highs from a couple weeks ago. So volatility has dropped a lot. So overall, we still have, for the most part, trading ranges being smaller than the average of years and years ago. So I wanted something that would give me quick entry, quick exit, and I could, get in on something that would kind of react quickly. So the 5 and the 9, there's no doubt about it, is more for the day traders out there. Remember, I work with people of all different time frames. They're trading day trade, they could be trading swing, they could be trading intermediate, they could be trading position. Again, I always tell you, what can you achieve? If you have a full-time job, I don't think that it's going to be a smart, thing to be trading on the job and have your boss come and look over your shoulder. So each of you listening tonight is a different trading entity, a different trading personality. And so this 5 and this 9 moving average might not work for you, but if you're looking at it on a longer time frame, what moving average works for you if you're looking at days and days and days of trading instead of a few minutes or a half hour of trading? Maybe you can use the 21 and the 50. Maybe you can use the 50 and the 100. You can adapt what we're talking about tonight to longer time frames that match your trading personality and what you're trying to achieve. And again, I said questions will be coming across, so I'm just looking to see if the first one, is there an edge in only trading one currency pair versus many currency pairs? So the question again is there an edge in only trading one currency pair versus many currency pairs? I can, I guess, equate this to when I'm working with people in the equity and the options markets. The more volatile it is, the more action you're going to have, and the more frequently you're going to be trading. The less volatile it is, the more you have to widen out your watch list a little bit. So for me, when I'm working with equity traders, an intermediate trader might be looking at 10 to 12 to 15 entities. But in really slow markets where they're only trading once a month, twice a month, which is what an intermediate trader is supposed to be doing, they might need 20 or 30 entities because it's just slower and they have more time to research and they're not trading as actively. So the same thing with foreign currency traders. I think one is definitely limiting it unless you're really, 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 really active. But if you understand the relationships between this region of the world and the euro and the Great British Pound, maybe in some of their similar needs as far as economies and what their central banks are doing, then maybe you can look at the euro and the U.S. dollar and then also the pound and the U.S. dollar, and then you'll probably understand the euro against the pound. It depends on where you are around the world and what's moving. Right now, obviously, Asia's going, Europe is getting ready to go in a few hours, America's closed, so it's kind of slow if you're looking at the U.S. region of the world against the European region of the world. So it just depends on where you are and what you can kind of focus on given what time of day you trade and how often you're trading, meaning how long you expect to be in the trade given how many hours you can focus on the market. So the busier it is, the less pairs you need. The slower it is, the more you want to kind of take a look at others because there are pairs around the world in different places against each other, and that's something to take advantage. Me, I kind of keep it pretty simple. I live in the U.S. I understand what's going on in this economy, and I compare it to one other, like the euro or the pound or the Aussie or the New Zealand. So I stick to pretty much the majors, but that's just my comfort level. So everybody is a little bit different. It just depends on where you're at, all right? Again, everybody is a different trading entity out there, and I can't stress that enough that this webinar may not, the 5 and the 9, may not work for everybody out there. You've got to make sure that you know what your trading personality is. So the 5 and the 9 time frame reacts quick enough to take advantage of small moves. Again, remember my last webinar on volatility and trading ranges. You can go ahead and watch that on IBFX's YouTube page, because a month ago we were in not a lot different, but definitely tighter trading ranges than what we've seen over the past couple weeks. And again, what else can you bring in to support your theory? Can you use the keywords of trend and support and resistance, which I'll show you? Can you use fundamentals? You cannot forget about these because they are what's driving the markets, all right? So the next slide here gets into application. Let's get into some trade setups. Let's go live in the markets, and let's focus on your pairs where you can chime in and say, hey, can you look at this? Remember to be realistic. Remember to be realistic. I can't stress this enough. What is the average trading range for the time frame you're looking at? If you have a 30 pip range for the 3 or 4 hours that you're in, you can't go for 50 or 60 pips. And the 5 and the 9, for the most part, isn't meant to go after that. The 5 and the 9 is meant to capture a handful of pips, 5, 8, 10, 15, 20. So it's not even there anyways. But if you can't ask for more than what the markets are giving you, so make sure you're being realistic. Before we jump into the IBFX MetaTrader 4 platform, let me just roll over into the sister company here, TradeStation, and I just want you to see volatility over the past few months and what's happened here as of late. Volatility rose right before the end of the calendar year because the fiscal cliff worries in the U.S., and then all of a sudden they got it straightened out and volatility dropped again. And then all of a sudden here, and this pattern was pretty cool. It was very hard to say the S&P or the equity markets are overvalued, but it was a little bit easier to say, hey, if I use trading plans and trading patterns and chart patterns and technical analysis, at least I have a plan and I'm okay putting the trade on. If I have a loser, I have a loser. If I have a winner, I have a winner. On to the next trade. I manage it the best I can. Well, what pattern right here, you guys? We're talking obviously about moving averages tonight, but here's your classic chart pattern. One bottom here, two bottoms here. There's your double bottom right there, and there's your explosion off of it. And again, you had no idea that there was going to be the Italy election and the outcome of it and the outcome of the sequestration and what the Federal Reserve minutes were going to be. But you didn't need to know that. All you needed to know is, based on past performance, this is what a double bottom looks like to me. I can buy it here near the bottom. I can put my stop in below because it may go against me. There's no guarantee. And if not, hopefully it turns around and goes up and does what a double bottom does. And here's my neckline kind of right here. They're measurable, so 1460, let's see, 1480-ish down to 1230-ish, so $1.50. It should do that $1.50 again right here. So 15 all the way up to 1650 or something like that, and obviously it went way above that. But that's managing a trade. That's paying attention to technicals helping you. And then, oh my God, it's going my way. Why? Because there's fundamentals. What are these fundamentals telling me? Now I can continue to manage my trade. I can take off some of the shares that I have or the option contracts as it's going my way. I can move my stop off. I can manage the trade. I can massage the trade. So whether you see a double bottom here in the VIX, the volatility gauge, or in the euro US dollar, it doesn't matter. We're pretty much managing it the same way. So just on the flip side, so you can see the opposite, here's what the S&P did in reaction. No double top for sure, and I can bring this down on a smaller time frame. Definitely not a double top up there, but it definitely did, as it populates. It's thinking. All right, we're not going to get the 60-minute up there. Let's see. We'll stay on the daily. So definitely not a double top up here, but definitely a move lower. But it was easier to say I'm a buyer in the VIX markets due to a double bottom versus trying to say I'm going to pick a top here because the chart pattern wasn't the same. So just keep that in mind that it's back to technicals with a really, really good focus on what's going on fundamentally. Okay, I can't stress that enough. It's got to be a combination of both. Let me just see before I jump in if there are any questions. All right, so moving forward, let me just see if someone was talking about audio. Okay. All right, so let's go into, like I said, the MetaTrader 4 platform. Let's apply. All right, let's apply and let's be realistic. So we're going to jump in right here, and it might be, someone was just saying about audio, sometimes it has to do when I'm flipping back and forth on the platforms, that it might just, you know, give you a brief pause there, but I think audio is working for mostly everybody on. We got a pretty large crowd on tonight. So I already drew a 5 and a 9 here. I kept the 5 as a red because that's kind of my trigger moving average, and then I put the 9 in yellow. So I already drew it on there, but I want you guys to see me draw it on there because some of you may not have used this in the past. So sorry, I got to keep moving this audio panel out of the way so I can see the different currency pairs. So we'll pull up the Euro US dollar. Let's look at the daily first just to get an idea of what's going on. And I'm going to go ahead and pull all of these objects off. So again, everything is right click, and then I go to my objects that I drew, and I'm going to take them off. And so we'll start with fresh screen, and I go up here to my indicators, my plus sign, and again, different indicators mean different things. You've got to know how to use it. So moving averages work better in trending markets. So I want to put a moving average on with a 5 period, and I'm going to keep it red. I'm going to keep it the color red because that's my trigger. So the shorter moving average is the one I'm looking to cross up and down. And then I'm going to go ahead and put my 9 moving average on. I go to trend, I go to my moving average, and I go to 9, and I'll change the color to yellow. All right, let's put gold. We'll go with gold yellow. All right, so this is a daily chart, and this is what's going on with the Euro US dollar on a daily basis. And as of late, as I said, the dollar is definitely strengthening because ever since February, we went from 1.37 down to 1.30. We lost 7 pennies, 700 pips in the euro, and right now, look where we are. Can you guys see some support down here? Maybe around 30 even, nice psychological number, nice 000, and it bounced right around 30 even for the most part a few days ago. All right, we'll see what happens below that. But we're not really concerned with what it's doing, you know, longer term. We just know that the trend has been down as of late. So that's what I'm saying is, what else can you use in conjunction, and what is going on macro? You know, the dollar strength a little bit due to various things coming out of the Federal Reserve here in the U.S. All right, so I'm just checking back for a question here. Let's see, first time here, so I do have a question. Can I get the same setup on my TradeStation as the MetaTrader platform? Never used MetaTrader platform. MetaTrader is slick. That's what IBFX uses. So I'm not doing anything on TradeStation tonight, even though I do webinars for them, but I use their platform. So that's something, if you guys have questions, remember, I don't work for TradeStation or IBFX. They're sister companies, and I work and do webinars and commentary for both. But if you have questions specifically about their platforms, that's what you want out of your broker is customer service. That's what IBFX excels at. That's what TradeStation excels at. Call them and find out what works best for you and what platform. I'm a very visual guy, and so I like this platform a lot. I like setting up the way. It has a nice customization and adaptability to my needs. So I do use multiple different brokers for different reasons and different trading strategies and different trading lengths. But this one, as far as the Forex brokers out there that are specific Forex brokers, like IBFX, the MetaTrader 4 platform is very, very popular, and that's what, and it's popular for a reason because it's built very well. Remember, MetaTrader is a separate company that they basically are linked into these various brokers. So it's very widely used, and you can do a lot of neat things with it. But again, that doesn't mean to say it's right for you and your needs. So that's why you want to be in touch with your broker, each of your individual out there. So that's a good question. You've got to be in touch with your broker, and they should be bending over backwards for you, and that is what both of these companies generally do. So now that we know the overall pattern here, we're going to just slink this down. There's the 4-hour chart. There's the 1-hour chart. Again, showing that decline as of late for the past month in the U.S. dollar, gaining against the euro. All right, and then we go, and so we know that trend. And so I'm going to keep going down because the 5 and the 9 is a short-term day trader entry. There's no doubt about it. 30 minutes. So 30 minutes, we can see basically the last week of trading, and then we can see 15 minutes the last week. So keep in mind the euro went 1.37, 1.35, 1.33, 1.31, 1.30, and it came down to where there was some previous support. So that may have changed your perception. Hey, if I wasn't already short and taking advantage on a long-term trade, do I really want to be getting short after it moved down 7 pennies? What's my risk reward here for the longer-term trader? The shorter-term trader might be saying, hey, we just came down 7 pennies, 700 pips, we have some support down here. You know what? What's being said out there, everybody's got a currency war, everyone wants to weaken their things. I'm not sure I still want to be short the euro here. Maybe I want to be the short the euro when it pops back up 32, 33, 34, and I think it's overvalued there and it comes back down. But for now, maybe I'm interested in being long the euro. So basically, we see the euro definitely going down and then starting to find some support, like I said, down at that 1.30 area. And yesterday was a 26. That's when Bernanke said we're here. We're still going to weaken our dollar, so the equity markets go up. All fears are gone that, oh my God, is the U.S. dollar going to be raising interest rates? Absolutely not. A fundamental event telling us we're not going to raise interest rates. And over the past couple of days, shorting the euro versus the U.S. dollar was probably not the way to go, because over the past couple of days, the trend started to go up. So what I want you to focus on is every time the red line, crossed up and over the yellow line, the 9, like here. It crossed up and over, and that's an entry to get long. And then it crossed down and over, and that's an entry to get out. And then you say, hey, I don't mind being long the euro down here. I think it's a much better value than 1.37 or 1.35, 1.33. So when the red line crosses down and over, that doesn't mean I'm shorting the euro, all right, or shorting the U.S. dollar anymore. I'm waiting for the 5 to cross back up over the yellow line, and I want to get long the euro. And I ride it out, and then the 5 crosses back over the 9. Very quick exit. I'm out, and I had a gain again. The 5 crossing over the 9 to the downside can be a short entry. You can get out of your long position, get flat, and get short right away in reverse, but you don't want to, because fundamentals are telling you equity markets are going up. Ben Bernanke speaking, you know what? The U.S. dollar might give back some of its gains from 1.37 to 1.35 to 1.33 to 1.30, and I'm kind of more bullish down here. So yesterday and today, yesterday kind of sideways, but today was definitely a trend day up in the euro against the U.S. dollar, and being long made much more sense. The equity markets went up, the U.S. dollar went down against most currencies out there. So that's how you're using it in conjunction with other data. Let's see what the pound did today. There's the pound, pretty much a trend up. Had a little bit of a correction in the middle of the day and a trend up. Let's see what the Aussie did against the U.S. dollar. Today, there's your sideways action, and then your trend up later in the day. So it took a little bit longer to get going. But definitely, remember, the Australian banks are closed when the Euro banks are open, or the European banks are open, and when the U.S. banks are open. Now, U.S. banks are closed, European banks are closed, and the Aussie dollar is open, their banking area. And what do? Oh, in reaction to the U.S. dollar going down, in reaction to the Federal Reserve saying this, in reaction to the equity markets going up, Asian markets open up and their equity markets open up big, and you have a big blast. So if I apply my 5 and my 9, I go down to my trend, my moving average, and I'm paying attention to all these fundamentals. I put the 5 on first, I do my colors here, and I get my red, and I put another moving average on, and I get my yellow, my 9. Let's go to, whoops. There's our yellow and our 9, and I apply, and again, you can see the trend here, guys. You can understand the fundamentals. Look at the entries going long, not short when the 5 crosses down and over the 9, but when it crosses up and over. Here's the short entry, and it doesn't do much. It goes down a little bit, but here's the entry long, right here long, and you're still in that trade. And that's why I like the 5 or the 9, because it's a quick exit. Yeah, I could give back some pips on the way down, but I'm not going to give back that whole move. Right here, I get in long the Aussie against the U.S. dollar, and I get out here. I'm flat, I'm flat, I'm flat, and I'm in again. And remember, these are 15-minute bars. So you may only you're not trading 24 hours a day. You might be trading 3 hours at a time, 5 hours at a time, 6 hours at a time. That's a day trader. They've got to be in front of the markets 3, 4, 5, 6 hours easily in a row, and they might have 1 to 2 trades a day. In this case right here, you're trading as the Asian markets open up, so very late in the U.S. time, late, really late in the evening, almost towards the morning in the European time frame, but in the Australian time frame right here, that's when you're starting to trade, okay? So late in the evening in Europe for sure, afternoon in America, but Asian markets opening up and going, and that's could be your trading time frame right there, is 8 o'clock or 7 o'clock GMT time to 2 a.m. GMT time. So that's your 6-hour period right there. All right, 4, 5, 6-hour period, and that could be your 2 trades right there. That's a pretty good day. That's a pretty good day for a day trader. Was this move? 101.95 up to 102.30. There's about 35 pips in that range. 102.25 up to, and again, I've got to move the panel, so I apologize. Bear with me. To 102.80, another 50 pips or so. 2 trades, not too bad, but you're using fundamentals, you're using a technical indicator, and you're managing the trade. All right, an announcement could come out right now, snap of a finger. You're moving your stop up, I hope, and starting to manage that trade, maybe taking some off, maybe looking to see if there's going to be some kind of MACD, bearish divergence, something like that, bring it in. Is there some resistance up here we might run into? You're bringing a lot into account, and that's what it takes to be a trader. I don't care what time frame you're trading, what market you're trading, a lot of effort goes into placing a trade. I can't stress that enough. For me to get into a trade, it's very hard. It takes a lot of work. If it was easy, everybody would be traders and quitting their job. And if it was easy to do without thinking, everybody would be making money constantly. We know that it's not that easy, and I work hard at it, and I expect you guys to work hard with it, and I expect my clients that I work with to go ahead and work hard with it. So let me just go ahead here and answer these questions as we wrap up. Is it applicable for all time frames and all pairs? Again, the first thing I said is, what's the trading range? So how many pips is acceptable? So that's your first thing, but also what time frame are you trading on? A 5 and a 9 does not work for the longer term trader. This is definitely a short-term day trading entry and exit system, and someone I would expect to be in front of the markets 4, 5, 6 hours at a time in a row. All right. Is there a difference if you choose simple versus exponential in the moving average method? Not when you're going this short term, because it's taking into 5 periods and 9 periods. It's going to be the same amount of data. When you start taking into account longer time frames, 100-period moving averages, 200, then there's a little bit of difference. But again, there's no holy grail. You just have to stick with it and say, I'm a trader that's analytical. I use technical analysis in this indicator. I use fundamental analysis to help me. I use trend and support and resistance and other things. And so whether you're using the exponential or simple, you're still going to be pretty close, and you should be getting in for the same reasons, because you think it's oversold or overbought and you want to go in that direction versus this direction. Are these EMAs? These are SMAs that I'm putting up there. So that's your question. I don't know if they're the same thing. They're not. Exponential weights the most recent data more heavily, but again, when you're doing 5 periods versus 9 periods, you're looking at such a small batch of data anyways that the EMA versus the SMA won't really matter. So let's flip out of here. I try and stick to about a half hour because these are recorded, and you guys don't want more information than that. I think I threw a lot at you, and I think we were able to apply this, is what my goal was, to 2 or 3 pairs, which is what I wanted to do. So applying it live in the markets, looking at a few pairs, be realistic, and make sure that you're taking other data into consideration. Review. Fundamental events, I can't stress those enough. Technical analysis, trend, support, resistance are big, and then you throw on your other indicators and tools onto it. Why do I use the 5 and the 9? Because it works in these small trading ranges. Again, no guarantees that it works every time. I'm not saying it works that it's profitable every time. I'm saying it works because it matches for this type of volatility in this type of trading range, but it could still be a loser. I just have to manage that, and I have to make sure that I bring other things into consideration. All right. No guarantees out there. Definitely not a holy grail, but I think that it's a good one for these type of trading ranges. That's what I'm stressing, is it's not going to work every time, but for these trading ranges, if you're a day trader, the 5 and the 9 can be quite useful in conjunction with other analysis. Questions and resources. I think y'all got your questions out throughout. I'll see if there's any more. We will meet in 2 weeks again. I just created those webinars. We will be talking about retracements. I was doing the webinar creation a couple of days ago. Markets were retracing in the equity markets. I'm going, this is great. And then all of a sudden the Federal Reserve comes out and says, oh, by the way, we're going to make the equity markets go right back up to their highs. So my retracements webinar in 2 weeks might not be as valid as I thought it would be, but we still have 2 weeks, and that's a great thing. Tomorrow's a new day. We wake up, you get excited about the markets, and you get excited to be a good, disciplined trader and make sure you trade with good account risk and trade risk. It's all about trading psychology, you guys. I can't stress that enough. There's lots and lots of webinars I've done on trading psychology. So how do you get those recordings? You go to the YouTube page for IBFX, and you'll find my 36 or so videos there. My daily market commentary talked about volatility today, and it talked about trading ranges and being realistic today. So some trading psychology there. That's at dailyforextradingedge.com. And then also you can find my site and my approach to trading, my approach to education at jupiterpeakfinancial.com. So take advantage of those great resources. Take advantage of your broker. Be in touch with them. Let them help you and assist you. One final question, and then we'll wrap up. Someone said they had audio issues and missed most of the webinar. Yes, this will be recorded. It will be compliant. It will go through recording, so you can review it. And like I said, on that YouTube page for IBFX, I have about 36 videos or so, and I have done the 5 and the 9 moving average crossover. It'll be stale because I've done it in past data. This one obviously is for data right now, but I have done this webinar in the past, and I like to review it because it's really, really applicable right now. So good morning, good afternoon, good evening, depending on where you are around the world. Hopefully this was helpful. I look forward to seeing you every day on my market commentary page at the dailyforextradingedge.com. If you have questions, you know how to get a hold of me. My email is right here. Happy trading, invest intelligently, and look forward to seeing you on another webinar in 2 weeks. Thank you, everybody.